In this video, I want to go over a very important concept. A lot of people fail to become profitable because they do not focus on this. They don't pay any attention to it. And with trading, we can position ourselves to be incorrect as much as possible, yet still make money and still be profitable. A lot of people have it twisted and they make one mistake cost them, or they make two mistakes cost them. They blow up their accounts and they have no money left to trade. So in this video, I want to go over a couple of key points that I highlighted. And as I break them down, I'm going to go into actual trading examples so you could see it on the chart a lot better and relate the points to each other. Before we get into it, I'm going to post a link for my Instagram in the description below at Ameritrade. This is my only account. I post daily trading recaps on here along with really good trading tips and tricks that I guarantee you're not going to find anywhere else. The link will be in the description below. You're seriously missing out if you do not follow me on there. But now let's get right into these points. So the first thing I want to explain, I say this in a lot of my videos, and I do see a lot of people do this on a daily basis. They take a losing trade, they try to figure out what they did wrong or how they can improve. And a lot of people, and if this is you, accept it, acknowledge it, be aware of it. But do not enter a trade just because of what you think the market's going to do, where you think it's going to go, and don't enter just because you see it moving up or moving down. Your thoughts have zero influence on the market. You can't predict what's going to happen next, and your thinking of where we could head is not going to influence the direction of the market. For example, a lot of people, they see the market coming down, they say, okay, it's moving lower, I'm going to get short. Or then they see the market moving up, they say, okay, it's moving up now, we got 3 green bars to the upside, let me get long. Just because the market is moving does not give you a valid reason to enter. You need to have more confirmation and you need to have a valid thesis before you enter any single trade. This is vital, this is key, and many ignore it because they let their ego and their bias get in the way and they enter for no good reason. With this being said, and once we have a valid reason for entering the trade, we need to know where we are going to exit if we are incorrect. This is the basis to this video. This is vital. And if you don't know where you are going to exit, you are entering the trade blind, especially if you don't have a reason for entering that setup. So once we have our reason to enter, we now need to know where we are going to exit if we are incorrect. This is our stop loss. A lot of traders do not have a solid reason for entering a trade. What they will do is they will see the market coming down like this. They will get in the market short. So now we're in short at this oval right here. This is our break below level. Now the market starts moving lower about 10 points and they see, okay, we're up $1,000 at this point. So we got short at the top oval. We're up $1,000 at the bottom oval. Nice trade moving so far. And then they see the market start moving up. Those 3 green bars, some volume coming in. And what do? They exit the trade maybe for a $100 loss or a break even because they saw they were up $1,000. They say, okay, I made that last week in my day job and I was up that in 2 minutes with the market. Now we're starting to come up. I'm about break even or I'm down maybe $50, $100 on this trade. I don't want to lose money on this setup. I don't want to be really bad red. So what am I going to do? I'm going to stop out of this trade at this oval right here. And guess what happens? The market comes back down and your $1,000 win that you had earlier, if you didn't stop out for a red trade, now you would have made a lot of money and you could have been up, let's just say $5,000 in this case. And if you followed your plan or even had a plan, you would have made money on this setup. A lot of people get out of trades prematurely because they do not have a valid area where they place their stop loss at. Or they just don't have an exit point in general. Also, on the flip side, let's just say we don't have a stop loss or an exit plan. What's going to happen? Let's just say we get the market long off of this demand zone. It starts moving up. We're in profit. We put our stop loss at the low. Now the market breaks the low. And guess what happens? We don't exit this trade when we break the low. We say, okay, we're going to rally from here. I don't expect the market to keep moving lower. My ego is telling me, or I think we're going to bounce and keep moving higher here. Your ego is going to cost you a lot of money, especially if you don't have a stop loss and follow it. Because what's going to happen here is the market moves back up, and then guess what happens? We eventually break, and your small loss that you could have taken if you put your stop loss at the low now turned into a bigger loss because your ego wanted you to stay in this trade, and now we just lost $5,000 when we could have just only lost 300 bucks on that original stop loss area. So if you don't know where you're going to exit, do not enter that trade. Your stop loss level should be based on the chart where your original thesis will be proven wrong. Where will your analysis be wrong? It is not based on a dollar amount or a percent amount. You fluctuate and fix your position size to fit that according to your risk parameters, but your stop loss has to be where your analysis is wrong. Not where you think you're wrong, it's where your analysis is incorrect based off of the chart. For example, this was a trade that I took in the Discord. We were watching a break below 3992, and I was interested in playing shorts for a sell-off into the demand zone lower at 3972. So essentially, a break below this level is where I played the market short. Now, as we broke this level, got valid selling confirmation, my target is at the demand zone lower. Where I put my stop loss in this case was a reclaim back inside of this earlier range around 3997, 4000, because if I got in short when the market broke below this seller level, if we reclaimed back inside of this range, this reclaim into that range would have invalidated my original thesis of taking the market short and expecting a very large sell-off to the downside. Here's an example on Tesla. So Tesla bounced off this demand zone earlier in the day. Let's just say we did not get the market long off of this earlier demand zone. We rallied, then we pulled back into this level. We got long now once we saw a nice buying volume at this demand zone. You can see high volume right over here. The market made a higher low out of it. We get long up here. This was our entry. Our entry was based off of a higher low, high volume inside of the zone, and maybe we spotted buyers on the tape. This was our reason for entering that trade. That's step number one. Step number two, once we get our entry, we need to know where is our analysis wrong. This is our stop loss. It's not off a dollar or a percent amount. It's where on the chart we are incorrect. So if we enter long at this green circle right here, where is our analysis being correct? Well, there's 2 points that I see in this example. The first one is the previous low that it just created on higher volume, or low a day in this case. If we take the market long and we break below these levels, I would say the chances of the market bouncing will be incorrect. This invalidates our original bullish or long thesis. So in this example, based off of the risk parameters on your own account, let's just say our stop loss was below this level at 169.50, where our entry was at 170.50. So we were risking about $1 in this case. Now, we need to know where we're going to exit if we are correct. Many might not agree with this, and I'm also not going to agree with myself in certain cases by having a target. It's vital to know where you need to exit, where the market could reverse at. But sometimes you could catch a larger move. Maybe you scale at your original target. Maybe you get out 50%, 75%. There's many ways to get creative and play with it. So some might not agree with having a target. In this example, let's just say we have a target at this intraday supply zone at 173.50, about 174. So we're risking about $1. And where we are going to exit out of our long position, if we are correct, is at our target at 173.50. This gives us a 170.50 entry, a 169.5 stop loss, and a 173.50 target. This offers a 3-to-1 risk to reward. We are risking $1 for a $3 reward. So you should really aim for at least a 2-to-1 risk to reward. Obviously, the higher, the better. But we do this so we can position ourselves that we could afford to lose more often. You want to set yourself up to be wrong. I don't want to say as much as possible because that's not the right way to approach it. But you want to position yourself to be, when you are incorrect, you can be incorrect more often than not, yet you could still be profitable and you could still make money. The higher our risk to reward means we can be right as little as possible, yet still make money and still be profitable. Here's a great chart illustrating this. On the top, we have our win rates. 20%, 40%, 50%, 60%. And on the left, we have our risk to rewards. 1-to-1 means we're risking $1 to make $1. 3-to-1 is we're risking $1 to make $3. And 5-to-1, we're risking $1 to make $5. So on this table, we can be correct 20% of the time with a 5-to-1 risk to reward ratio and still be profitable. So think about that. You can be wrong 80% of the time and only be right 20%, yet still be profitable. But now let's go to a little bit more of a realistic risk to reward, 3 to 1, 2 to 1. With a 3 to 1 average risk to reward, we can be right 30% of the time, yet still be profitable. With the 2 to 1 risk to reward, we got to be right 40% of the time. So if you see anybody say, oh, I have a 100% win rate or a 90% win rate, if you aim for win rates, it's completely irrelevant in your trading. Obviously, you can't have a 5% win rate. You need to have some structure, but risk to reward is more important. And a lot of people disregard risk to reward when it's the most important function to trade management. So pause the video if you want on this table. It's vital and it's key, showing you do not need to be right more often than not to make money. You can be wrong and still make money. So when you do everything that I've been saying so far, you are going to be less influenced by emotions. Our emotions are our greatest enemy. The market is not against us. We're not against the market. We are only against ourselves. If we can control ourselves and control our emotions, we will be a better trader. If you do not implement proper risk management, your trades are going to be severely influenced by your emotions. So here's another example. Let's just say we wanted to get long when the market was holding 3955. We're in long, we see it holding our level perfectly, and as the market starts moving up, we get in long. We're long up here. We need to put our stop loss below the low. This would invalidate our thesis. Our thesis would not be invalidated, right here. It wouldn't be invalidated right here. It would have to be at the low a day, which is about a 9-point risk. And let's just say our target is at 3976, 3978. We're risking about 9 or 8 points to make 20 points to the upside. So it's a little over 2 to 1, about 2.5 to 1 risk to reward. What a lot of people will do is they'll see the market come up here, then immediately fall back down, and now they're about break even on this trade. They freak out, they exit the trade prematurely, not realizing their stop loss never triggered, and then the market moves up and hits their target, and they would have been in this trade if they implemented proper risk management. You need to have a valid stop loss, and you need to have a valid trading plan, target, entry, stop loss, before you enter that setup. If you could do this, you will be less influenced by emotions. And one thing I do want to say is if your losses are more than double or triple your average wins, it's going to be very, very difficult to be consistently profitable. If you see an average winner of about $500, $1,000, but maybe you have one losing trade or two losing trades that are $2,000, $3,000, look in your journal. This is very, very important. If your losses are about double, triple your wins, you're doing something wrong and you're not implementing proper risk management. If you have an average $100, $200 winner, and then maybe you take maybe 2 or 3, 4 times a month, you take $1,000 loser, it's going to be very, very difficult to be profitable in the long run. Believe me. No one is going to know where the market's going to head next. The only thing that we can do is follow our plan and manage our risk. As traders, that is our only job. Follow our plan and manage our risk. Now, this is also getting a little creative. Maybe I can make a different video on this. I actually think there's one in the course about it, but adjust your position size according to volatility. If there's a lot of volatility, the market's moving in a large range, maybe go smaller size because you're going to have a wider stop loss and a further out target. Whereas if there's not a lot of volatility and the market's in a tight range, then maybe adjust your position size a little higher because your risk is going to be smaller and your reward is also going to be a little bit diminished as well. So depending on the conditions, you need to have a valid stop loss, targets, entries for the different conditions that the market may present to you. So never add to a losing trade. If you are wrong, you are wrong. You can always get out. The flexibility of a retail trader is being able to get in and out when it doesn't make sense or in and out fast with smaller size once our target or our stop loss gets hit. If you're wrong, accept that you are wrong and get out. Many people cannot accept they are incorrect. They want to be right all the time and they take a very large hit or they add to a losing trade and they're essentially adding fuel to a fire. They're adding alcohol to a cut and they're just burning themselves even more. If you're wrong, you're wrong. Accept it and get out. Focus on the next setup and play defense over offense. The best teams play defense, they win the championships. If you can be disciplined in your entries and exits, you trade without emotions, you will make money in the long run consistently and profitable. So I'm going to end the video on that note. I hope you all got some value out of this. If you did, I would appreciate a like. Let's try to get 1,419 likes. Check out the links in the description below. I offer a very in-depth and educational course. It comes with access to the Discord at no extra charge. But I'm going to end it on that note. Peace out.